For everyone coming in, we'll look to start around 1:05. Feel free to introduce yourself in the chat. Jessica and I were just having some technical shop talk, if you will. But we'll look probably, like I said, around 1:05 to start it off and then go right into the presentation.
Okay. Let me share my screen. Okay, can everyone see my screen?
Yes.
Okay, great. Okay, that's me. I am talking today about deconstruction tax deductions. What this means, I'm going to apologize from the outset. I know my slides are thick with words. It's for a reason. There's a lot to this. It is very complicated. This is a very valuable tax deduction. And as such, I want to make sure that these slides can be referred to and have a lot of the full information. More detailed information, our website has a lot of articles I've written that dive into the tax code and go beyond the scope of just the slides. So we have a tax deduction that is actually
wait, real quick, Jessica, we'll wait another 2 minutes to collect people. I'll give a little spiel and we'll go into your presentation.
Oh, perfect. Oh, I'm sorry. I thought you
no worries. No,
you can shut me up.
This is all recorded. Yeah, no, this is all recorded. Okay. And because Laurel isn't here, my co-chair, who actually owns the Zoom, it's hard to kind of start recording a single time. So at 1:05, we let everyone come in. I give my 30-second spiel, and then we'll go right into it.
Got it. Okay. And Melissa, I'm so excited to see you here. I see Melissa Lenzel, my friend from Minnesota.
Hello. Hello, hello.
Melissa actually presented last month about policy direction and simple steps Minnesota and the region are taking that hopefully New England and our region can start working towards. So it's been very helpful to kind of find out best practices either across the country or the region that we want to kind of bring to Boston and the Northeast. So very, very exciting stuff. We'll give it 1 more minute.
Melissa has motivated me. I now have a new used bike that I got from a nonprofit. And Virginia is not rider friendly, but I'm following Melissa's lead and going to make it rider friendly and insist that I can ride a bike in this town without getting hit by a car. So thank you, Melissa.
We were fortunate to have Jessica present to our Boston Deconstruction Initiative recently, particularly around our most recent project, Simmons. So that was really useful. So I'm thrilled that she is getting to address this group as well.
Okay, so it is 1:05. For Laurel, when you look at this, we'll cut now. Welcome everyone to the August 2023 CLF Boston Reuse Group. Today we have a presentation from Jessica Marschall and the Green Mission about the tax incentives and financial incentives for deconstruction and material reuse. We'll let the presentation go. For those in the audience, if you have any questions, you can either type in the chat or wait until the Q&A afterwards and we'll address them. There isn't too much afterwards, so as long as this takes, we'll let it go and right up until 2. So Jessica, if you want to introduce yourself and get right into it.
So I'm Jessica Marschall. I live in Fredericksburg, Virginia, and I have this company is the Green Mission, Inc. We do appraisals for deconstruction donations. I also have probity appraisal, where it's more of the traditional art and collectibles. I'm a CPA of 23 years, and I also have a tax and advisory separate practice that I've run for 23 years. So today we're talking about deconstruction tax deductions. And it's this part of tax policy that you don't find it linked with any of the energy credits or labeled as a green initiative. It's evolved into a way that we use a certain part of the 1040 and the 1120 for corporations. I'll get into the details there, but it's essentially a tax program that can, or a tax deduction that can have an amazingly environmental positive effect by reducing the amount that we're dumping to the landfill. So getting into it, as I said before, I apologize. There's going to be a lot on these slides. It's internal revenue code, so we need to have a lot on these slides. And if anyone has any questions and wants to dig further into the code, feel free to reach out to me. And our website also has a lot of articles that go much deeper into the code, as well as specific circumstances, tax court cases, etc. Okay, so we have demolition versus deconstruction, which is the standard duo that we're competing with here. It's about 50% less to demolish. You think about that because you've got a wrecking ball coming in, with the goal being to break things into the smallest pieces to fit into a dumpster to mitigate and minimize those dumping tipping fees. So deconstruction is the careful unbuilding or disassembly of a building, or of just an interior of a building, residential, commercial. There is the tax deduction that I'm going to discuss next, and this helps to bridge that gap between the increased cost of deconstruction versus demolition, and to soften that timeline, because especially when we're doing these jobs in New York City, sometimes the demolition contractor is saying, okay, hold on, you've got 1 week here to extract what you can, then you're going to be holding up my schedule. So those are some of the challenges that we're facing and why this tax deduction is helpful. Okay, so how does the tax deduction work? Individuals and pass-through entities. So if you think about LLCs and S Corps, just remember those pass through to the individual 1040. The majority of these deductions are taken on the 1040. There's also the 1120 for corporations where these can be taken. On the Schedule A of the 1040, these are itemized deductions, and these are taken in the same category where one would donate a Picasso or an Andy Warhol or vintage jewelry. These are non-cash charitable contributions, and we treat them in the tax code and in the appraisal world just as seriously as we do when one donates fine art to charity. And the IRS expects the same level of care in taking these deductions. Any donation that's worth more than $5,000 requires an appraisal to go with the donation. And it needs to be appraised at fair market value, as opposed to replacement cost comparable for insurance, or other values like liquidation value. We're appraising at fair market value. So here is where this deduction comes on the Schedule A. This is the itemized deduction for non-cash donations, and this is where we try to bridge that gap between the demolition and deconstruction costs with the tax deduction. So it's limited. It's limited to 50% of adjusted gross income. So, and that did not change with any of the congressional bills that have come out, that it's still 50% with a 5-year carry forward, even those years where they adjusted the cash donations. This was not adjusted. So if your AGI is $100,000, you can deduct up to $50,000, and then any portion that's not used has a 5-year carry forward. Same with 1120s. But the 1120, it's a limit of 10% of net income. And then there's some add backs like dividends received deduction. There's a whole list of those. If a corporation needs more information on this, they can reach out to me. I have articles that go into detail on the corporate donation. But it is available pretty much to any entity, whether they're a pass-through to the 1040 or a corporation to the 1120. So here is an example of the mechanics of exactly how this works. So let's say there's a kitchen renovation and they're donating cabinetry, appliances, vanities, and some light fixtures to a qualified 501c3. That's a kicker. You have to donate to a 501c3 or a governmental organization. The taxpayer's effective tax rate, let's say, is 30%. That's the average tax rate there, calculated by dividing the total tax by taxable income on the 1040. And they have a state effective tax rate of 5%, let's say. Each state is different. Most states do allow for the deduction of charitable contributions. I have an article that delineates which states do and do not. For example, Pennsylvania does not. These are all questions that you need to know going into a donation to know what the after-tax benefit would be. So if that cabinetry and everything was valued at $18,000 fair market value, then the net tax benefit is their effective tax rate combined 35% times the 18,000. So it's $6,300 is how much you save on your taxes. So if you're looking at corporations, if they donate $300,000 worth of corporate material and property, the net tax benefit, if their corporate rate is 21%, which it is under the TCJA, net tax benefit will be $60,000. So the first step to look at is when someone's considering donating, what is your average tax rate? Take that, multiply it by the fair market value. That is the tax savings dollar for dollar in general. It is not equitable, and this drives me nuts. If the IRS ever or Congress asked me to rewrite the tax code, I'm still waiting for that call. This is one of the areas that I would really, really hit hard. If this were turned into a credit, it could be equitable. And it could, if we turn this into a refundable credit, we could all of a sudden reach an entirely different socioeconomic part of the country that currently may not be donating. And this is why in this example. So a donation worth $100,000. We had a client in Tennessee, they two-spouse home with 3 children, adjusted gross income 90 grand. Their effective federal tax rate was only 9% and state of 7%. So that $100,000 donation was worth $16,000. The same donation in New York, when you have an AGI of 500,000, is worth $37,000 in after-tax benefits. So you see the discrepancy there. And in some cases, we've had families, especially towards the middle of the country, that have multiple children and they have almost sometimes 0 effective tax rate. So there's no motivation there in the tax rate for them to donate. And then you talk about the higher costs of deconstruction over demolition. This tax deduction is supposed to bridge those gaps. Let's say the New York, it ended up being an extra cost of 10 grand to deconstruct. They've got 37 grand in tax deduction. So that's still a net benefit of 27 grand. For that couple in Tennessee, an extra $10,000 going through all of this for a $6,000 deduction, the motivation isn't as high. It drives me nuts if they could ever move this into the energy credits and have it be equitable and have possibly even refundable. That's my wish to Congress's ear, but I know they don't tend to be very efficient with these things. Okay, these are very technical considerations that I'm just going to run through. Keep them in mind and reach out to me if you have additional questions. So there needs to be basis in what is donated. This is where a lot of our corporate donations, especially hotels, these fall flat. We get called in all the time for huge hotels that are going to renovate. They are getting rid of everything. So then I drill down into their balance sheet with their controller and everything's been depreciated. They have no basis in their assets, in their televisions, in the beds, in the furniture. So you're limited to, if your basis is 0, you can't take the fair market value so there's no motivation to donate for the tax deduction. We're working on a number of other scenarios where we're helping to get hotels to donate anyway, but that's a different webinar. If you own the property, you need to make sure if you're an individual, you've owned it for a year. Same with corporations. You have to accomplish the long-term capital gain holding period treatment to take the tax deduction. So it's the 365 days. They have to pay good attention, especially if someone buys a new home and decides to renovate. If they haven't owned those interior contents for a year, they'll be precluded from donating at fair market value. The IRS delineates between a dealer and an investor. The best way to remember this in layman's terms is usually a house flipper who buys homes and flips them with the intent of making profit off the flip is a dealer. An investor is someone who invests in the property with the profit motive being to hold on to the investment, and the appreciation is the profit motive. So it's a gray area, and there's a lot of really good scholarly articles that have been written on the dealer versus investor, but it's one that the IRS can swoop right in and potentially disallow a donation if someone is a dealer. There's also a back-end basis adjustment. When you take the fair market value deduction on a property, you have to reduce the improvement value in your holding period, which will create a larger straddle and capital gain once you eventually sell. It's kind of beyond the scope of this webinar, but I can go into much more detail with that. If you didn't do the basis adjustment, you'd be double dipping. You'd be taking the tax deduction and avoiding that amount of capital gains on the sale. Like I said, 5-year carry forward for individuals and for corporations. So it's a great tax planning strategy, especially since in 2025, our current tax code, which is the TCJA, the Tax Cuts and Jobs Act, that expires in 2025. That tax law is estimated to have cost the US government $3 to $4 trillion in lost revenue. So you throw in 10 trillion on COVID spending and everything else going on in our government, we're looking at higher taxes, no matter what politician says what, this all translates into higher taxes. The TCJA is not sustainable long-term, so it really helps to just prepare clients that their taxes are going to be higher. What does this mean for deconstruction though? When taxes are higher, these deductions are worth more. So starting in 2025, these numbers for clients will naturally work a little better because the tax rates will go up, especially when we go back to that example of the Tennessee and New York, where we see the majority of these projects happen are people with higher AGI, because there's a larger magnitude of deduction for people who have higher earnings. It sucks. I'm not happy with that, but that is the way that we see things right now. So starting in 2025, it's something that I prepare tax clients for. If you're donating to charity, by definition, it may be worth more in 2025. Okay, appraisals. The IRS requires these appraisals. These are the critical document upon which this tax deduction rests. If the appraiser or the appraisal is not considered IRS qualified, they can toss the entire deduction. Who does it hurt? The taxpayer. Why does it hurt them? Because you usually get audited 2 or 3 years post submission, and they go back and let's say they claw out $100,000 in tax deduction, you underpaid by the amount of that deduction. There's fines, penalties, understatement penalties. It gets messy very, very quickly. So it's very, very critical that the taxpayer procures an appraisal that is qualified. There's no licensure for appraisers, for personal property appraisers. The IRS did beef up requirements they started in 2018. Some appraisers were able to be grandfathered in, but that did help a bit. However, it's not as easy as being an architect or being an engineer or an accountant, where there's tests that we need to take. There's no licensure. So the taxpayer needs to look at the level of education for the appraiser, make sure that it's in something that lends itself to valuation methodology, finance, accounting, ensure accreditation. There are 3 organizations here that sponsor the Appraisal Foundation, which is the congressionally developed organization that oversees appraisals. So the ASA, AAA, and ISA are the 3 personal property foundations or organizations. So the appraiser should be accredited at one of them at least, because that shows that they've taken the time to take the valuation methodology courses, they've had their appraisals reviewed. Then of course, there's the fund Circular 230 that CPAs and tax attorneys are held to, appraisers are as well. So if one has been involved in any criminal practices, anything like that, they can't be a qualified appraiser. Okay, what is being valued when we're doing deconstruction? There's a lot of confusion about this. Some say, oh, this is real estate that's being donated. It should be a real estate appraisal. It's detached personal property because of the detachment principle. So when you remove the dishwasher from the existing real estate, it by definition becomes personal property the second you remove it. When you install that dishwasher, it automatically becomes real property. These are two case studies that we needed to, we get a lot of work where we're working with CPAs to correct appraisals that are non-compliant. A home in Arizona came to us and the appraisal was a real estate appraisal valued at 1.2 million. And they had procured a real estate appraisal for the improvements of this home. And what they had argued to us, what the nonprofit argued was, well, we're taking every last piece of flooring and doors and fixtures. So it's essentially the same value of everything when it was intact. It is not. I mean, we all wish it were, because that would make deconstruction a heck of a lot easier if these were based on real estate values. The correct value was 250 grand, which is still a very, very good deconstruction tax deduction, but it's not 1.2 million. So the IRS has been flooded with the real estate. There's something in the Internal Revenue Code that's called DEFRA compliance, DEFRA, and the Form 8283, and these appraisals fall under DEFRA compliance, meaning it is strict compliance. You get one shot in that one tax period to procure your qualified appraisal by a qualified appraiser. If you screw that up, if you miss a single box in the 8283, if your appraiser isn't qualified, they can disallow on the technicality. And if you look on our website, there's a number of tax court cases that have disallowed on technicalities. The donor loses everything. You can't go back and get the qualified appraisal. There's also, the IRS has sought clarification on some of these where they say, well, wait a minute, was the cabinetry that was donated, was it actually able to be reused as cabinetry, or was it just a pile of sticks, essentially like mulch, which would obviously have a much lower value. So appraisals need to incorporate into there that deconstruction is the careful disassembly of contents to ensure that they can be reused again in their original state and condition. Correct valuation methodology. This is very similar to when my other company does business valuations. We're tethering to actual asset sales on the secondary market. It has to be the correct market, which is the secondary market. We're not looking at Home Depot. Home Depot prices are much higher than the prices for these gorgeous vintage 2-panel leaded glass doors that are only appraising, for $300 or $400. To get those new is $3,000 or $4,000. So what we have to do as appraisers, we search the secondary marketplace and we base our conclusion on comparable sales data. So what I've done with my company is I created an internal database where we have about 600 price points that we've integrated into a database. So we can run statistical analysis on, let's say there's a Bosch dishwasher. We can say, okay, we have data for 2,000 Bosch dishwashers. Here's the mean, median, mode. Here's where the trend. Enables us to see some fun things like the demise of the pedestal sink, which most of you don't know about, but during COVID, the pedestal sink proved how unfunctional it is. And as people were stuck at home, they got rid of all these pedestal sinks, flooded the secondary market with them, drove up the prices of vanities because the vanity gives you more storage space and makes people happier when they're at home. So pedestal sink values went down and vanity prices went up. That's what we're trying to capture as appraisers. There have been tax court cases where, and a lot of the appraisals we review, some appraisers use the cost new less depreciation. So it's using software like RS Means or Marshall and Swift, putting in the data for a whole house as if it was being built new, arbitrarily assigning depreciation, and it spits out a number in about 5 minutes. You plug that into an appraisal, you've done the same work in 5 minutes that it takes our team to do, a month of research and writing. It doesn't track to market and it's not acceptable to the IRS. As all the appraisal organizations have stated, 98% of personal property appraisals are done using the sales comparison approach. The cost approach would be if there was an indoor mural that was hand painted by a living artist and we needed to appraise that, what that would be. That is the cost approach, because we would need to determine what it would cost to hire the new, hire that artist to make a new mural. The cost approach is used for insurance valuations because you're looking to replace at the cost. Everything else must be based on sales market data. So this is the critical part. This is where the rubber meets the road, and this is why we have to be quick in this process. So what usually happens with us, we work nationwide. I usually get calls from a nonprofit contact or someone who found us online or a developer, and they say, I've got 2 days to potentially consider a deconstruction. And I'll use an example. There was a church up in Harlem. It was this gorgeous building. It was actually on the Historical Society registry. It just wasn't strong enough to remain that way. It was purchased by an LLC that were going to put up a box store. Why we couldn't have the box store in the existing gorgeous granite cladding that was 6 feet thick, granite clad building, 3 stories. And we got a call from one of my great friends, Evan Blum, who's up in the New York area. He's with Irreplaceable Artifacts. He's amazing. And he called and said, I know you're in New York. Can you come over and look at the building? So I looked at it with him. Our team crunched the numbers, and we found out that the value of those materials was about $3.5 million on the secondary market. If that were to be built new, it would be cost prohibitive, 30 million plus. They don't create granite cladding at 6 feet thick for new buildings. So we reached out to the client. We sent them our quote within 24 hours. A client must get these quotes within 24 to 48 hours so they know what decision, what choices they have. It gives them time to call in their CPA. Hey, what's my effective tax rate? Do I have income to offset? What can I do with this tax deduction? We get that quote out, and we don't ever charge for these quotes. And no one should, because this is the decision-making part. If there were to be a cost or revenue affixed to that, we could, people could be precluded from even looking into deconstruction. So that's an area I insist is always going to be without charge. Then we got back to that donor of the potential donor of the church and said $3.5 million. They talked to their demolition contractor. They said, nope, that will hold up our timeline too much. I'm not going to deal with any of this. Don't consider that. So then on December 31st at before midnight, so it was time, I got a flurry of anxious phone calls from this client and their CPA who had just seen the quote. And they said, this is incredible. You're going to be throwing all of this away anyway. You can use this deduction. The higher cost of demolition pays for itself in the donation. They effectively conveyed all of the property to the nonprofit by December 31st. So they could make the donation within the tax year 2022. And they ended up being able to extract all of the granite, the antique elevator, the antique marble, clad walls, interior. They were able to salvage the majority of the external and interior elements, which are now going to be reused in existing construction, where New York City, imagine creating a new building that has 6 foot thick cladding and Roman columns. It's going to be amazing. That's how quick these decisions have to be. And that's why that people have to figure out, what is this tax deduction worth? How do I get that quickly? And then how do I proceed? Okay, so the correct appraisal steps, I won't go through these in detail. You can just look through these later, but there are things to look for in appraisals. Making sure that there's the literal descriptions. The IRS wants the condition. They actually want photos that can be pixelated up to 8 by 10 in some cases. So they want a good photo addendum, comparable sales data. So this literal description of a door, this is what we would do for a door. Then we dig into the comparable sales on the open market, looking at the most recent sales for doors. Geographic area does matter for certain property. Like in the Southwest, there is a distinct market for certain property that comes from Native American tribes that are indigenous to that area. Same thing in the Northeast, we see a lot of when there's Cape Cod teardowns, a lot of nautical themed lighting that has a higher market there than, let's say, down in Georgia. So we look at the market, then we make adjustments to value based on the condition, based on if the leaded glass is superior in this one door to the other. This is how our correct presentation of a Wolf cooktop, for example. We do a lot of these types of appliances that are pulled out during a deconstruction. This is the incorrect presentation. These are the kinds of appraisals that we've had to work on redoing because they don't provide the detail the IRS wants. And why does it have to look this way? Not because I say so, it's because the IRS tells us this. I attend all of the appraisal organization conferences IRS counsel presents, and they say we are not looking to disallow non-cash contributions, but in all of the Internal Revenue Code, something of that magnitude where you're essentially donating what would otherwise be tossed and saving thousands and thousands of dollars in taxes, you darn well better do what the IRS says and document this correctly and make sure they're done correctly. These are cases you can look at on your own that go into disallowances for deconstruction. These have been tough to stomach because it's done a lot to hurt the deconstruction industry, mostly with CPAs. I spend a lot of my time speaking with colleagues and talking them through the non-cash donations. So in all of the thousands of pages of tax code, the non-cash donations are a relatively small, not common thing. Prior to 2019, when I opened this company, in all the years of taxes that I had been preparing and consulting on since 2020, I only saw 2 non-cash deductions. One was for a Steinway piano. The other was for art. It was all very cut and dry. That was it. So we're seeing a lot more deconstruction, a lot more tax deductions. This is all wonderful, but we have CPAs who read our accounting literature, Accounting Today, AICPA, that hammers down, look at this. There's somebody who donated deconstructed building materials and it got disallowed. So we really have to do a lot to show CPAs what this deduction is and help spread the word through the tax community to recommend these things to clients, because we all know clients that are renovating, and even if they don't take the tax deduction, just getting this out into their minds that these materials can be salvaged and donated, and the good that they can do is critically important. So this is a pilot project that I worked on in Martha's Vineyard with the amazing groups that are listed there. South Mountain Company, they were willing to, and this is part of their mission, is they want to incorporate sustainable building practices into their model. Waste Not, Ann and Liz are some of the best deconstruction contractors you will ever meet. Here's the challenge. Martha's Vineyard, you are all from the Northeast or have been there. It takes a whole day to get in and out of Martha's Vineyard on the ferry, and getting materials out of Martha's Vineyard in any sort of way is very difficult. I mean, Cape Cod is difficult, much less Nantucket or Martha's Vineyard. So this was a huge challenge that that Waste Not Recycling Works, Carroll's Trucking, and CET especially, they were in Eco Building Bargains, where Jay McCauley, who she's since moved to a different company, but she was with CET, and the dedication that it took to pull this off and be able to show this as an example. If it can work in Martha's Vineyard, I feel like it can work anywhere. And what we were able to do is 10 tons of materials were diverted from the waste stream, recycling rate of 59%. The fair market value of the materials paid for more than 3/4 of the cost associated. So the costs were obviously higher. This is Martha's Vineyard. The tax deduction wasn't able to offset 100%, but 3/4 of the cost was amazing. And the homeowner was a wonderful lady, and she was insisting she was going to donate these materials. The tax deduction helped to cover 3/4 of that extra cost. So we're hoping that more projects like this and this model can be used throughout the country, like I said, to show homeowners what the choices are. And then outside of my scope is when we look at the nonprofit reuse companies, when we're looking at eco building bargains, Second Chance in Baltimore, out in Minnesota, Better Futures, Minnesota. We've got Patrina with the Birch Group, all over Chicago, recycling. Then we have Rebuilding Exchange. There's just too many to list. These are all nonprofits that are taking this material. And the key and where we're all kind of a bit strangled is the tax code requires that these materials are donated to a nonprofit or a governmental organization. I also disagree with that because there are many reuse companies that are for profit that could also be accepting these donations. But again, Congress hasn't asked me to rewrite the tax code for this. So we have to deal with the system that we're working with. And what I'm hoping happens, which I spoke about a little bit in the beginning with Michael prior to the starting, is we need to expand the secondary market. We need the volume of materials that are being extracted from these projects to fill the needs of new consumers in a timely and a complete manner. Meaning that if someone is constructing a residential home, we want the option where they can source the majority of those materials from secondary sources. We're not even close to that now. I'm renovating my own kitchen, and I'm writing and journaling about the journey that it takes just to get the materials for a single kitchen, making sure that I'm close to 100% sustainable. So what we need is for all of these nonprofit recipients to work together as a network with for-profit to build up what essentially will become like an Amazon or like a Home Depot used, where there's one place building contractors can go and order all the hardwood they need, and they know it will be consistent. They know it will be high quality. They know it will be denailed. Until we get that, we're getting hit or miss projects where there's people like me who, and I even know where to go, and I see, oh my gosh, this is taking, I'm going to have to go to 10 different sources just to get the lumber and framing lumber and flooring that I need. I'm willing to do it. Most people will not. And we're also dealing with the timeline, especially in the Northeast, where the time is money. And we have, there's people just will not take they're not willing, and they really can't economically take the extra time that it would take to source 100%, being a fantastic goal, from reclaimed materials. We have to get there. I'm working with the carrot, which is the deconstruction tax deduction. I need the sticks as well. Minnesota has the grant, Hennepin County deconstruction grant, that's awarded to people who are doing deconstruction. We have deconstruction ordinances that are popping up. Denver just came up with a new one, and I wrote it down somewhere, and now I've forgotten already. But Denver now has waste no more in Denver. Boulder has mandatory the deconstruction consideration. So we're getting there. We just have to keep pushing, because if people are forced to look first at what can be deconstructed, we're going to have the source for these materials to build up the secondary market. What we need is the market then to respond, absorb these materials, find a way to expeditiously deliver these materials in the content and quality and quantity that people want. And then what I'm going to see as I'm researching this market is that the prices and values are going to rise as we bring more demand to this market, because right now people have no idea that you can get an HVAC unit for $600 down the street at a nonprofit that was just extracted from a Northern Virginia home that had just replaced it 2 years ago, but they're redoing the entire home. Deals like that, people, they're kind of one-off. They think of it as goodwill shopping. We've got to augment that market, and that's really where that's outside of my realm. But what I'm going to see, like I said, is the values moving up. I can't emphasize enough what a big tax deduction this is in the range of other deductions and credits. You get $300 for getting new windows in your home as a credit. You take your child to daycare and the 2441 sometimes reimburses you, $800. Well, thanks. I spent, 24 grand on childcare. We don't have a lot of really hard hitting tax deductions like this that are readily available to people who, don't own a REIT or don't have multiple LLCs. It's an amazing tax deduction. And with that comes the responsibilities, which everything that I've discussed earlier. The quote, like I said, these have to get out to people as soon as possible. What I do is if any of you ever need a quote to go to someone, you just call or email me. I will get my team to get that quote out immediately so people know what that potential fair market value is, and they can take that into consideration when they're looking at the costs of demolition versus deconstruction. The appraisal is going to include everything, must include everything in there, because if the industry gets any more black eyes through tax court, it's going to be detrimental. And we need the IRS to trust us as an industry that we're using this tax deduction correctly, that there's no malfeasance between nonprofits, no collusion with appraisers. The list of potential abuses goes on, which really shining sunlight on the process helps quite a bit. With our clients, the appraisal is confidential, and under USPAC, we can't share any of the report with the nonprofit or the deconstruction contractor. However, we created a workaround, and I have our donors proactively determine if we can share the appraisal or not. 99% of them all check the yes box. So then when we finish this appraisal, the appraisal goes to the nonprofit. The deconstruction contractor can see it. Everybody can see the appraisal. So there's nothing being hidden in there. My CV is out there for everyone to see that I'm an old 47-year-old nerdy CPA. There's nothing I can do about that. Sunlight needs to come on all these appraisals. And a lot more. I'm working to build the deconstruction appraisal industry. I'm meeting with a lot of other appraisers, especially business valuation appraisers, and they have the skill set to do this, and I'm helping them to expand their practices with the hope that eventually we have enough deconstruction appraisers that'll be similar to CPAs, have a large pool, and up the quality of work that's coming out from the pool. And that's all I've had. I've talked all of your ears off. I'm sorry, but I get very excited about this, and I'm quite passionate about this tax deduction in particular.
Thank you, Jessica. There's a couple of questions in the chat. If anyone in the audience has a question, please use the raise hand function. But going through real quick, can you just give a little bit more explanation about the 5-year carry forward? Okay,
5-year carry forward. Let's say that you have a deconstruction tax deduction of $100,000. Your AGI is $100,000. That means you're limited to 50% of the AGI, which means you can take $50,000 in year 1. It carries forward for 5 years, meaning in year 2, if you have another $100,000 of income and you still have 50 grand left over from the tax deduction, you can take it all in year 2. If that amount goes down, you have 5 years to use up the deduction before it expires. Keep in mind, like I said, 2025, for sure taxes are going up, if not sooner. So in effect, these deductions will be worth more in 2025.
Questions. Can you explain the role of in the deconstruction pilot, the unique role did maybe the designer play, contractor play, and how they could contribute going forward to other projects such as this?
Yes. Okay. So let's start with South Mountain. They are the amazing resource. Checking in first with South Mountain and CET would be the first go-to. They oversaw a lot of this. South Mountain wanted to rebuild using whatever existing portions of the home that they could. So to salvage a portion of, there's no need to tear down certain walls if you can reuse them. So they designed to maximize sustainability in the new structure and they were willing to give the time to Waste Not, which is Ann and Liz, to extract what they could. So we all met there the first day, and then CET oversees all of this, all as a recipient organization for there's eco building bargains where these materials can be sold, as well as the CET has the most incredible think tank. Every time I hear something super brilliant coming out of somewhere, I'll look, oh, they work for CET. That's amazing. Lisa Pellegrino, she just wrote something on LinkedIn last year. It just blew my mind. I love her. Okay, so we had Waste Not coming in with us and South Mountain and CET. We went through the entire house and looked at all of the inventory there. I captured it in photographs. Then our team created a spreadsheet that line itemed, hardwood, refrigerator, counters, any of the furniture, doors, solid core doors, the sinks. So we had the whole list. We ran that by Ann and Liz, and they let us know, yes, we can salvage all of this. Sometimes, especially if it's an older home, the deconstruction contractor will say, nope, that has issues. That's going to have to go to either recycling or to the dump. Then with that list, we worked with Ann and Liz. Well, I didn't do it. I don't know how to deconstruct. I wish I could. Ann and Liz extracted all of those materials, which were then taken on a boat over to the CET, which had eco building bargains, then recycling work. Carol's Trucking helped provide the consolidation of everything into as small a space as possible, because if, as you know, Martha's Vineyard, the space is money, getting everything over to the mainland where it can be reused, and looking throughout Martha's Vineyard to potential uses of the material on island, so it didn't need to be shipped. So that was how it worked. Essentially, any project where everyone can get those key players in the same room, even for 15 minutes, it's amazing what could be done on a lot of these projects.
Amazing. That's all the questions in the chat. Does anyone have any questions right now? If not, I have one, but to open it up.
So this is Jim. Sorry, real quickie. So you see a lot of projects like this. You see a lot of quotes. But sort of, what's the realm of what's the breakdown between sort of small scale residential projects and larger scale, either more residential or more commercial projects?
We see a lot more residential because of the flow of the tax deduction, and because with corporations, they've already depreciated a lot of the interior contents. It's another part where, but we have some great workarounds. I'm working with some hotel chains now that are putting sustainability goals on the table for their owners. And then where we have come in is we know the nonprofits and governmental organizations, as well as other people who need these materials locally. So then we can show the hotel owner, hey, we can have this school district bring their trucks and pick up everything, no cost to you. That takes away, this portion of your budget you have to put towards the dump. So it's all integration of existing recipient organizations, but it needs to be a lot bigger, because you wouldn't believe, we've seen office buildings in New York City that had $10 million invested in office furnishings, computers, and equipment. COVID hit, they never even opened the office. 1 week demolition, we couldn't get them to budge. It all went to the dumpster, all of it, still wrapped in plastic, done. And that's what we're up against. And I feel like what I'm catching are the little raindrop in a cup. The rest of the waste that is being poured out on this country is immense. We have to do something about this, and we have to hold organizations like that accountable. They could have supplied a neighbor. The neighboring school there in New York City is struggling. They could have used all those computers. It was heartbreaking. So that's what we're up against.
Follow up on the different organizations. Where do institutions like colleges and universities, some are sort of nonprofits themselves or public but they're not corporations either.
So they can accept, we did a project up in Baltimore, which was an entire corporation that had basis in the assets. They're relatively new. And we were able to disseminate everything to 25 local school districts. Some came as far as Delaware. And the feedback that we received from some of the schools, one was able to fill 3 basketball court areas full of desks, computers, and equipment. They were able to reduce their budgets for buying the fixed assets that they needed. And they said that the money that frees up could go towards paraeducators. It can go towards, more help with kids in the classroom. So that was a great model project. What we found as well is when we're calling to do those donations from corporations where we're blanketing an area, there's a lot of small players that don't have the outreach to let us know that they have needs. So we find out about them, and sometimes it would be easy to divert. Like we could have done that entire office to probably 3 school districts. But what I really try to stress with our staff is find the little players. And the best story that we had was there were cubicles in that building. And we found a school that said they wanted the 10-foot cubicles, which we couldn't find any place for them. We thought these are going to end up ruining our diversion. They're going to the dump. It was a school for blind children, and padded cubicle walls provided training for the students to walk and learn how to navigate. So it's one of those things that had we not kept calling the 200th organization, 201, we wouldn't know about them. So now we keep a list of those organizations and we blast out, okay, we have potentially desks, computers, unused bedding that's still wrapped from hotels. And then they get back to us right away and we can get things placed.
Jessica, one question I had, in CLF, Boston and Northeast, there's a very heavy design presence. And coming from the construction side, oftentimes something I feel is, if only the drawings or specs had this or that. And you can go through the owner sometimes, but there's real power in the design. From your point of view, what would you want from a project? What would be highly beneficial if you have drawings for the demo or deconstruction scope to include or the design points that you put into a project that would really push forward deconstruction?
So do you mean incorporating, so the designer incorporating reused materials at the point of design? Is that right?
Yeah, if that's one of the things I've said before, and we've had presentations before that if we could put this in the specifications, if you could call out these items. From what you've seen, what would your wish list be for designers?
So I actually have a client that's unrelated to this. They're in my tax practice, and they've created software where an architect and designer, they call it 6 clicks to fill commercial bathroom spaces, for example. And Kohler has come on board to promote using reused plumbing fixtures, because a lot of the low flush toilets are still perfectly usable 2 or 3 years. So if those can be designed for implementation, having the secondary market as the first line of attack for any design, especially when you can sell that to your client, like the example I used at the beginning, the pop and go cabinetry that were able to be, they cost $200,000 to install. The new owner purchased them for $15,000. They were never used. They were just in a, so we had in their architect, for example, designed using that same, the cabinetry. And there were some adjustments, so there were some missing cabinets that they needed to remove to fit the space. But knowing that you have the volume of material there, it won't do any good to design to use sustainable materials and property if they're not readily available. So we have to increase the volume. We have to get these products into the hands of consumers and make the secondary market the primary.
Great. Last call for questions.
Yeah, I've got my hand up, Mike. I'm not sure if you can see. It's Kathy.
Please, Kathy.
Thanks. Hi, I'm Kathy from Massachusetts. Thank you for this very interesting presentation, Jessica. Couple of questions. How might we get the word out about this to those who could take advantage of this tax deduction? So I'm thinking, is it, you know, so it gets to the homeowner level, I guess, or to tax advisors or whomever. I'm thinking of the build reuse wiki, you know, but that would be for certain folks whose heads are already in this, or for websites like ours at the state at DEP. And then in addition to that, sort of a kind of a concise way to get the word out so people even know that this is an opportunity out there. Do you know if there are also any kind of tax incentives for buying materials off the secondary market?
No tax incentives for that. I'll jump on that first. Again, if Congress lets me rewrite, we don't have that yet. That's a great, great plan that could be in there. In the federal tax code at the 1040 level, there are not tax incentives to do that. Number two, build reuse wiki is amazing. I just spent some time yesterday uploading most of this information to the wiki, so it's there. CPAs, like I said, are the gatekeeper. I spend a lot of time in my community going to the various and part of the AICPA in Virginia and and other states. I communicate a lot with the CPAs because then they can let their clients know about this. And it goes beyond deconstruction because everything in the house can be donated. The furniture, all of a sudden we have an aging generation where the younger generations don't want these things from their parents. And so we've had great organizations accepting things like we just placed a Warhol and a piece of jade last week, donated to a deconstruction nonprofit. The key is there's something called related use, and nonprofits need to make sure that selling the material is part of their related use. What would happen if, let's say, that piece of jade that had a fair market value of around $3,500, if that was donated to a museum in this year, and they took a deduction for $3,500, if the museum turned around and sold it within 3 years in a fire sale, let's say they really needed money, they sold it for $500, the IRS claws back the delta between the fair market value and the sales price. However, this is a great new avenue we've been pushing the past 4 years is people can donate their art and their other very high priced materials and property to these nonprofits who have as part of their related use to sell. Then you can have, let's say, an organization that helps for the unhoused in Indiana can accept something like the Picasso, sell it for whatever they want. There's no clawback because it's part of their related use. They use those funds. It's a lot of organizations. It's like, okay, you gave us a Picasso. We need bedding. We need, everything for the. So that's where I opened the other company, Probity, and we're getting people. I have another high-end apartment I'm going to on Sunday where they walked in and said, take everything. So we found some local nonprofits that will be able to take all of their art collection. We'll appraise it, tax deduction. So this is reuse of more than just building materials. This is this entire part of the tax code can help us as a community to start reusing things.
Seeing as it is 2, we'll look to close up now. But once again, Jessica, thank you so much for presenting today. To everyone in the audience, it will look to both send out the recording of this alongside these slides and Jessica's contact information if you want to get in contact with her. A great presentation today to really look at the financial and tax incentives. Going into September, the next meeting will be a bit more technical on the AEC side, looking to review actual waste materials and some different construction methodologies and frameworks to try on the commercial side to extract some of these materials. So once again, thank you, everybody, and the contact information will be sent out.
Bye.
Thank you.
Have a good one, everyone.